Good evening. We begin tonight with a developing story from the global financial markets that has captured the attention of investors, economists, and policymakers around the world. In an extraordinary display of market volatility and recovery, financial markets have witnessed a massive rebound over a remarkably short time frame, with trillions of dollars in valuation being restored to the global economy within just 30 hours. This dramatic turnaround has been accompanied by significant surges in precious metals trading, with silver experiencing a 20% increase and gold climbing 11% from their respective lowest points during this turbulent period. The financial markets, which serve as barometers for economic confidence and stability across nations, have demonstrated both fragility and resilience in equal measure during this latest episode of market turbulence. The $4 trillion figure represents a staggering amount of wealth that was temporarily erased from global markets before being recovered in what analysts are describing as one of the most rapid market reversals witnessed in recent financial history. To put this number into perspective, $4 trillion exceeds the entire gross domestic product of most individual nations and represents a significant portion of global market capitalization. The recovery began following a period of sharp declines that had sent shockwaves through trading floors in major financial centers across multiple continents. Markets in Asia, Europe, and the Americas all experienced significant downward pressure before the dramatic reversal took hold. The 30-hour time frame during which this $4 trillion recovery occurred is particularly noteworthy, as it represents an unusually compressed period for such a massive shift in market valuations. Typically, recoveries of this magnitude might unfold over weeks or even months, making this rapid restoration of value all the more remarkable from a historical standpoint. Within this broader market recovery, precious metals have emerged as particularly strong performers, attracting significant attention from both institutional investors and individual traders. Silver, often considered both an industrial metal and a store of value, has posted gains of 20% from its bottom during this period. This substantial increase reflects renewed investor interest in the metal, which serves multiple functions in the global economy, ranging from its use in industrial applications including electronics and solar panels, to its traditional role as a monetary metal and hedge against economic uncertainty. Gold, the traditional safe haven asset that has served as a store of value throughout human history, has climbed 11% from its lowest point during this market episode. While this percentage gain is lower than that seen in silver, it remains significant given gold's status as the most widely held precious metal by central banks and investors worldwide. The yellow metal's performance during this period underscores its enduring appeal during times of market stress and uncertainty, as investors seek assets that can preserve purchasing power when confidence in traditional financial instruments wavers. The simultaneous recovery in both equity markets and precious metals presents an interesting dynamic for market observers. Traditionally, precious metals and stocks often move in opposite directions, with gold and silver gaining when equity markets decline, as investors seek the perceived safety of tangible assets. However, the concurrent rise in both asset classes during this recovery period suggests a more complex market dynamic may be at play, potentially indicating a broad-based restoration of investor confidence across multiple asset categories rather than a simple flight to safety. The $4 trillion recovery figure encompasses market value restored across various asset classes and geographical regions. Stock markets in major economies have contributed significantly to this total, with shares of companies large and small participating in the rebound. The recovery has not been limited to any single sector or industry, but rather has represented a broad-based movement affecting technology stocks, financial services companies, manufacturing firms, energy producers, and consumer goods corporations alike. Market participants have been closely monitoring the factors that may have contributed to both the initial decline and the subsequent recovery. While specific catalysts for such movements can be difficult to identify with certainty in real time, the speed and magnitude of both the downturn and the rebound have prompted extensive analysis and discussion among financial professionals. Trading volumes during this period have been substantial, indicating active participation from investors making decisions about their portfolios in response to rapidly changing market conditions. The precious metals markets, which operate continuously across different time zones through various exchanges and trading platforms around the world, have seen particularly active trading during this period. Silver's 20% gain from the bottom represents a significant move for a commodity that, while more volatile than gold, typically does not see such substantial percentage changes in such compressed timeframes under normal market conditions. This surge has brought renewed attention to the silver market, which had been trading within relatively stable ranges prior to this recent volatility. Gold's 11% climb, while representing a smaller percentage gain than silver, translates into substantial dollar movements given the metal's higher price per ounce. For investors holding significant positions in gold, whether through physical bullion, exchange-traded funds, mining stocks, or futures contracts, this 11% move represents meaningful changes in portfolio values. Central banks, which collectively hold thousands of tons of gold as part of their foreign exchange reserves, have also seen the value of these holdings increase correspondingly during this period. The recovery in global markets has implications that extend far beyond the immediate financial returns experienced by investors. Market stability affects confidence levels among businesses making investment decisions, consumers considering major purchases, and governments formulating economic policy. The restoration of $4 trillion in market value within 30 hours provides a measure of reassurance that market mechanisms continue to function, that liquidity remains available, and that the financial system retains its capacity to absorb shocks and stabilize following periods of stress. Financial advisors and wealth managers have been fielding numerous inquiries from clients seeking to understand the implications of these market movements for their personal investment strategies. The volatility witnessed during this period serves as a reminder of the importance of diversification, risk management, and maintaining a long-term perspective when approaching investment decisions. While the recovery has been welcomed by those who maintain their positions through the downturn, the episode also highlights the challenges of market timing and the risks associated with making reactive decisions based on short-term market movements. The trading activity during this 30-hour recovery period has been facilitated by modern electronic trading systems that operate around the clock, allowing investors across different time zones to respond to market developments in real time. The infrastructure supporting global financial markets, including exchanges, clearinghouses, and brokerage platforms, has processed an enormous volume of transactions as investors adjusted their positions in response to changing market conditions. The smooth functioning of this infrastructure during a period of heightened activity demonstrates the robustness of the systems underpinning modern financial markets. As we continue to follow this developing story, the focus now turns to whether this recovery can be sustained, what factors may have contributed to both the initial decline and the subsequent rebound, and what implications this episode may hold for market participants going forward. The $4 trillion recovery in 30 hours, accompanied by substantial gains in precious metals, represents a significant financial market event that will likely be studied and analyzed by economists, market strategists, and financial historians for years to come. This concludes the first part of our coverage. We will continue with a more detailed examination of these market developments following a brief pause.